Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to help you with your retirement. We talk about retirement planning, how to manage your money during retirement and prior to retirement, and then, of course, how to handle the taxes during a retirement period. And so, we are here to answer questions. That's kind of how we handle this show. You can send in questions anytime, including now, if you want us to answer them live. Two ways to do that now. One is to send them via email, ask Tom at talkmoneywithtom.com, or send it via the chat here on the channel itself, and we'll try to answer those as they come in. Otherwise, we end up covering questions that came up during our strategy sessions with our clients. Oftentimes, there are things that people have questions about outside of just the people we were talking to. So anyway, this channel was put together simply because we felt like there wasn't enough educational material in this area. And we have found over the years that the clients that we have that have more knowledge about investing, retirement planning, tax planning, they tend to have better rates of return, even with us, and really higher net worths in often case. So I think that this is something you can grab onto. Go to our channel. There's all kinds of resources, thousands of videos. You can subscribe to the channel. You can hit the bell button if you want to find what's coming out for us that's new. And so feel free to use that as a resource. And then lastly, of course, if you just want to chat with Ethan and I, you can book an appointment. We make that real easy. There's a button on our website that looks just like that. There's a link to our website that's here on the channel. You go in and find a 30-minute time to meet with Ethan and I, and a phone in person here in the office or video, whatever works for you. We'd be happy to answer your questions one-on-one, whether you're a client or not a client is fine. We're here to help. At this point in our practice, and this is our 38th year or what have you, really just trying to help people as much as possible. So look forward to talking about this as we go. We start the video conference. Sorry, we start the show here with a summary of what I saw happening and we saw happening this week in the stock market. A big piece of investing is really being able to kind of understand what's going on, have some familiarity, so you can figure out what you need to do for the most part, right? And so, if we go to our little chart here that we've been working on, been building. This is week by week data going back to 2018 time frame, and market's doing well. At least this week we're up. We're up today, so if it holds up, we'll end up this week. Last week we were down, right, on the S&P 500. We haven't recovered all that.
Yeah, even though it's been a pretty volatile week, the week is pretty even.
Yeah, it's been kind of wild because I wear a green shirt on Monday. So I wear, different colored shirts on the Monday through Thursday videos, depending on, what the market did that day. A green shirt means that it went up 1.5% or more. A red shirt means that it went down 1.5% more. And I wore a red shirt yesterday. So, it's been, kind of volatile, although not to be unexpected, honestly. We've had a big run. You come out of this, Liberation Day and the pause on the Liberation Days, tariffs, and the market has been really on a tear as far as that goes. So, I'm not too worried about what's happening here in the short term, at least so far, as far as that goes. So, now, one of the things that has happened this week, and I think it's really even going back to next week, or last week, was just the fact that, we're seeing some weakness in the job market. There's no doubt about that. Matter of fact, last month in October, we had 153,000 layoffs, which is the highest one-month total we've had in the last 22 years. So we don't have a lot of other data coming from the government because of the shutdown. Some of that data apparently isn't going to come at all. Some of it is, so we'll have to see what happens. But, we've got these other private data sources, including this, number of layoffs. And the market's been kind of struggling with that ever since. And then at the same time, you had a situation 1 month ago. I'll show you the chart here. Oops, not working now. Oh, got to turn it on, yeah. A month ago where, the expected rate cut in December, right? So we had a rate cut like was expected in September. We had a rate cut like expected in October. And then we were supposed to have one in December, according to the market. So this is the the CBE, CME, groups Fed Watch tool, and this was, prior to this 1 month ago, a 94% chance of a rate cut, quarter point. And now we're down to a 46% chance, right? That's a huge differential. So the market is factoring in these rate cuts, and part of the gains that are coming prior to those rate cuts is the guess that we're going to have those rate cuts.
Yeah, they're trying to take a risk-off sentiment.
Yeah. And so when those rate cuts look like they're not going to happen, the market is going to readjust back down. Now, with one caveat, and that is, if the market feels the Federal Reserve is wrong, then you'll get an even bigger move. Because if the market feels like, oh, the Federal Reserve needs to cut rates, right, and they're not going to cut rates potentially, then, and the unemployment market is falling apart, and maybe the parts of the economy is starting to happen, those types of things. And so if they're too late for it, you could cause a recession, or make it, if we're going to have a recession anyway, make it deeper. And so one of those two things is happening because what's going on, and the reason, because there's no real change, there's no real data that says they shouldn't do a rate cut in December, right? Because all the data we've seen because they have a dual mandate, full employment, right, on one side, and 2% inflation for core PCE index, right, year over year. And right now, the job market is getting soft. Unfortunately, core PCE, as we'll see here, is going up. Now, we're back to where we were at the beginning of the year, which I think needs to be talked about too. So, however, the trend is troubling, and that's what the Federal Reserve is talking about. It's why they're coming out, like yesterday, multiple Fed governors saying they don't think a rate cut in December is, guaranteed. They're not saying they're not going to do it, but they're definitely not saying they are going to do it. And actually, Chairman Powell, in his press conference right after the last rate cut, said that December was definitely not, a guaranteed rate cut, and the market had already started to adjust to that. But, what's problematic here is the trend, right? So we hit a low right after Liberation Day, and now we're starting to see those tariffs slowly but surely coming through to price. I'll make a little bit of a comment here. I think it's kind of interesting because one of the things President Trump keeps talking about, prices coming down. He talked about it during the campaign, and he's talking about it now. And of course, for the people that are going to the grocery store, they know prices aren't coming down.
Yeah.
But the reality is that price as a whole rarely ever comes down. So that's a different thing. Yeah, usually when it's coming down, things are falling apart. It came down in 2008, 57% stock market drop. People weren't buying anything. Dealerships, car dealerships were empty, all of those types of things. So when prices are coming down historically, it is because of, some calamity. Now, individually, like eggs have come down, but that was because there was this big bird flu shortage, what have you. Gas prices, it keeps talking about been coming down nationally. I think they're a couple cents lower than they were at Inauguration Day. So the problem is that if you're going to tell people prices are coming down, you're never going to win that argument because it's up 3%. Even if it's up 2%, which is the target for the Federal Reserve, it's still up.
Yeah.
So it's just a matter of it's not about deflation, prices coming down, and promising people that prices are going to coming down is going to come back to haunt you because it's almost impossible to do.
Yeah, easier promise would be saying that your wages are going to grow and then and then prices are going to stabilize.
Yeah, exactly. So maybe we get back down to that 2% growth in inflation, and you're gaining, on wages 4% or something on those lines. That's exactly right, and that's more accomplishable.
Yeah.
It's almost impossible to run around and say all the prices are going to come down. It's a good campaign piece, but then when you actually have to execute it, it's very, very difficult. Yeah. So, so that's kind of what the Federal Reserve is looking at. They're looking at these. This is the slow growth of that overall prices to the consumers as the increase in tariffs starts to become more and more of a consumer cost and less of American company cost.
And we still have a long time towards the meeting. The meeting is not till, I believe, December 10th. So we're still well away. So more data will come out now that the government's been reopened. There will be data coming from the government. Yeah,
because we've got the September jobs report, the October jobs report. They're saying that they're only going to put out portions of those, not going to include the unemployment portion. But we will have a November jobs report, I believe, before December 10th. I could be wrong. They usually do that big jolt report early in the month.
I don't know about CPI. What would be?
CPI is usually later, more like the 12th, 14th, but it depends. So they might not have that. So it'll be interesting. And I don't know that helps or hurts. It's hard to tell. The Federal Reserve probably does have access to a heck of a lot of data outside of what the Fed government puts out.
Yeah, it looks like CPI is supposed to come also on December 10th.
On December 10th, the day they're doing it. So unfortunately, December 10th, that could have an impact because is the 10th a Tuesday?
I believe
Is that the first day? Because they meet on Tuesday, Wednesday, and then they announce the rate cut on Wednesday. And if Wednesday's the 11th, so they'll have the CPI during their meeting. Which would be interesting.
December 10th is the Wednesday.
Oh, on the Wednesday. Okay, so that won't help. Sorry. Anyway, interesting to see how that plays out in terms of a rate cut. I look at kind of the softness that's happening, and I wonder about the rate cut. I mentioned this week, just because when we look at the labor market, does a rate cut really help? Because the main reason, that they're touting, two main reasons that they're touting for higher unemployment or the number of layoffs we had in October are twofold. Maybe threefold. Number one, companies are spending money on AI, and they don't want to have lower overall earnings, so they're cutting back other costs, including labor, right? Number two, companies are spending money on tariffs. They don't want to pass all of that through to the consumers, or maybe they can't, so they're having to eat some of that. So they still want to have increasing earnings, so they're cutting on labor, right? And number three is artificial intelligence. Whether it's ready right now to take over jobs, it's probably already enhancing productivity for those people that are there. And obviously the thought process going forward, if you look at most of the company plans, like Amazon's talking about eliminating a tremendous number of jobs, trying to use robotics and AI and those types of things. Not that it's here yet, but it's something they're gearing up for. So AI spending, and tariffs. So if you lower rates another quarter point, how does that help unemployment? Because it doesn't really change the AI spend, which is really driving things, right? And they need that money. It doesn't really change the tariffs, at least on the standpoint of what's happening with the economy as a whole, and it doesn't change the whole employment picture. So that's why
is it
you're pushing on a string.
Yeah, is there enough impact if there's interest saved, basically, if they're using debt to kind of finance these spends?
Yeah.
Is there enough to augment that?
Yeah, we're seeing some debt in it, that's for sure, but there's so much private money still sloshing around chasing after the AI. But, are they using debt to fund the payments to tariffs? Probably in some cases, who knows? But, yeah, overall, theoretically, it stimulates the economy and would make more money available. But I think there's an interesting correlation between what's happening here and what the Fed can actually do here. Everybody looks at the Fed like they're this all-encompassing thing, but they can't always do what they need to do.
They have a hammer and they may need a screwdriver.
Yeah, exactly. That's good. All right, just the last point here is just, where are we in terms of this overall run as far as that goes? I feel pretty good that we're not done. I think, the dip buyers are still there. And one of the things you do see is just the number of days since the last 5% pullback, right? So the little triangles, the purple triangles there are all, historically how many days we got to. So the big one there in 2017 looks like a little over 400 days before we ended up with a 5% downturn. Very smooth market. We had a really good one going here just before Liberation Day, and you can see that. But where we are right now is actually not that stretched out in terms of just, how that market is going. We are stretched out on valuations, there's no doubt. But in these particular markets, I'm telling you, valuations aren't as important as they will be when things start to fall apart, right?
Yeah,
and
a lot of people have been using the Greenspan phrase, irrational exuberance.
Yeah, actually, and again, he had a lot of great quotes too. The market doubled after he said that. That was in '96.
Yeah, and so the market can be irrational longer than you can stay solvent if you start shorting the market.
Yeah,
Another
exactly.
saying that's gone around.
Yeah, exactly. Yeah, you have to be Michael Burry, that kind of capital to kind of hang in there, and that kind of fortitude to short Nvidia and Palantir and such. probably makes money on it if it happens within the next couple of years, because they use so much leverage. They can lose a lot, but then their gains are so high it kind of pays off. So we'll see how that plays out, but that's kind of what we're seeing here in this particular market. I still think the momentum's there. We're still in a primary direction up. That we haven't broken into a lower low in this uptrend. Haven't really even got that close to that, to be honest. We have not had even a 5% pullback. We are above the 50-day moving average. We're above the 200-day moving average. The 50 days above the 200. You name whatever part of the checklist you have for primary direction. Right now, the primary direction is up, and nothing is really changing that here in the short term, in my opinion. Outside of just, we've seen these outside influences like, hey, we're going to double the tariff on China or go to 100% more or whatever it is. And the market's going to struggle with that. And eventually that gets worked out. We did see something interesting today yesterday too. They're talking about cutting the tariffs on bananas, coffee, what was the other? Oh, beef. Mm-hmm. And so, they're acknowledging the increasing costs in those particular markets. And I think the beef is actually not so much tariff related, not that it won't hurt, it might help, but nonetheless, we can't make bananas and we can't make coffee beans here. I don't know if it's still true, but coffee was up 21%, the last report that I saw. And so when you're tariffing, a country like Brazil, for example, at 50%, so they might exclude coffee. And so this is what the whole market's been waiting for, is this chickening out thing, which isn't really chickening out. Well, I mean, honestly, in the first place, there shouldn't have been tariffs. They shouldn't have been there for those particular issues, in my opinion. But at least they're making those adjustments when they see things not working. And that's what the market has been relying upon. It's like, okay, when things start to fall apart, they can make these adjustments. And Trump has shown more than enough willingness to kind of make these adjustments. And he's not afraid to do those things. And they have. They made an adjustment to China. China's tariffs are now lower than they were at the start of, not the start, but, than they were certainly after the first set of negotiations that were done, finished up in Spain, for example. It's lower now after this last go-around. So, and I actually expect that'll go lower again. China will continue to use their leverage on rare earths and different things and slow walking, their soybean purchases or whatever they need to do. They have a long-term outlook on it, and I bet you they get that tariff down even farther just because, again, they have so much leverage. But anyway, so that's what's been happening this week. It's very interesting markets. I still think that there's some room to run here. Maybe not a ton. We'll see how that goes. But we haven't gotten to the end of this particular top unless something truncates it from an outside, situation, something crazy, which is always out there, no matter what market you're in, as far as that goes. So anyway, look forward to talking about this again next week. And so feel free to send in any questions. Let's start with our first question. What do we have
is a lack of a job report worse than a bad jobs report? So the Trump administration has talked about, delaying reports or not releasing full reports. What if there's no report?
Yeah. So let's think about what would happen in different scenarios. So if the job market was good, then Trump would like that. He'd be able to talk about how good it was. That's a big deal for him politically at this point in time. However, it would probably make the Federal Reserve even less likely to cut rates, which he really wants also. So if the job report was bad, that didn't get reported, that would be better for cutting rates. The Federal Reserve might look at that and say, we need to cut rates to support the job market. However, then it looks like the economy's bad, which obviously reflects upon the president, and he might want to do that. So I think it's a decision, personally, that they're deciding not to put this data out, because in the past they always have. They always made it up. Even though this was 40 days, we had a 35-day shutdown, they still got the data out. Mm-hmm. And so I think there's a reason they're trying to cut it and not show it. My best guess would be that it's actually not that great. Looking at the layoffs that happened in October at 153,000, they are going to put out apparently the numbers for jobs created, but not the unemployment number. And so, unfortunately, the number of jobs created has been revised. It gets revised. Yeah. I think twice, maybe even 3 times. And the revisions are massive. It's like, so whatever number you get, I think you got to, even no matter what administration it's been, it's like plus or minus 50%, which is kind of making it irrelevant to a large degree. And however, the unemployment piece doesn't change as much. That might be interesting to see. So yeah, so just make it worse. Get back to the question, sorry. Worse or better for the Fed? I think it makes it worse. The Fed needs as much data as they can get, because maybe the job market is bad. They don't want to show that because it reflects bad on the administration, but the Fed doesn't see it and says, hey, things are okay enough. We're not going to cut rates. And turns out it kind of kicks us into a recession faster than it might because rates stayed up longer than they should. So, yeah, I don't think it's a good thing. However, there's a lot of resistance on that board. It's very fragmented anyway. I've never seen anything like this where you have the dot plot that's that spread wide, where people are projecting, rate increases, and all over the board. So I think this next meeting is going to be really interesting. There is a lot more data to come, as you mentioned. So hopefully that'll kind of smooth things out, but we'll see. I wouldn't be surprised to see no rate cut, but never know. Depends on what happens between now and then. All right, what's our next question?
So why is the expectation of the rate cuts falling so much? It's down from 94% to the 46%, which is basically in half.
Yeah. Yeah, and that's just in 1 month. So 1 month ago, we were having a rate cut. I mean, the market at 94 is pretty high. And this is basically the futures market. So this is an important market to look at because people are betting money on this in this particular market. And so the reason that it's come down is it's weird because if you look at it, so we don't have the public data during this time period because the government's been closed, but we have been seeing some private data. The ADP private payrolls report actually was up and was better than expected, although it wasn't spectacular. It was 42,000 jobs, so it's not spectacular, but positive because the previous 2 months were negative. So that's a good thing. But then we got this report. I forgot the name of the organization that puts this out, but it's a private organization. It was 153,000 jobs lost in October via layoffs. And so there's been some big layoffs that have been happening, especially in the tech companies and different things on those lines. And so anyway, that is, going to be interesting to see how things play out as far as that goes. You find the name?
Yeah, it was Challenger, Gray, and Christmas.
Yeah, there it is.
There's the report.
Yeah, I think it's probably a CPA firm or something.
Yeah, it's just the lack of data makes people more cautious, right? You're shooting a little bit more blind. You've already made 2 cuts. Well, what is delaying another cut going to do? Right. But the market's fearing if they're too slow. Yeah,
and in the end, the thing that has dropped that percentage from 94 to 46% chance has been what the Fed governors are saying, especially this week. And so, they've been coming out saying, no, we don't feel like a rate cut is for sure. They're not, it depends on who's talking, but for the most part, they're not committing one way or another, but they are making sounds. And that's how you have to read the Fed Reserve. I mean, it's just all about, trying to interpret what they're saying. But if you interpret what they're saying, it sounds like they don't want to do a rate cut in December, or it's going to be much more less likely than thought as far as the market goes. And I think that's the biggest adjustment because there's no real data points that have come in and said, because even the inflation reports that we have got, inflation is going up, right? I mean, but it's going up pretty slowly. And so I'm not sure that would be the key issue for, not doing a cut. I think they've done 2 cuts. It's 0.5%. They just want to kind of see some more data and see how things play through as far as that goes. Who knows? I mean, by December 10th, the Supreme Court could decide on these tariffs. And so what does that mean, right? I mean, so there's 78% of tariffs were done under this emergency declaration. They could all disappear and go to zero the day after that they say this. All this negotiation with China and all these different things. So the tariffs that are still on, individual things like steel and copper, those type of things would stay because that was under a different tariff authority for the president. which technically is allowed, although that also has an emergency component to it from the standpoint of you're supposed to be protecting that particular industry from, unfair competition or a new industry that you're trying to get established in the country. And so when you're talking about steel, yeah, okay, aluminum, I don't know. They're probably going to have to, I bet you that gets challenged in court also in the end. So we'll probably have that in front of the Supreme Court as, what happens. So it's going to be interesting to see how this plays out. But nonetheless, overall, the Fed has kind of changed their tone. But we'll see what that means. All right. What's the next question?
So how do you know when dip buyers are done buying? Those last run, anytime the market's down 1% or 2%, you always see it rebound. On those really rough days, by the end of the day, it's come back quite a bit.
Yeah, the easiest way to tell, as far as I'm concerned, is just kind of using a chart. And so you take a look at that chart and you see, where are the support points. So you've got this situation where the market's going up, and you're going to have different periods of time where it kind of hits a high or consolidates at some point, and then it goes farther, and then it starts to come back down. And when it gets to that support point, and there's different versions of it, it can be a high points or it can be low points, and there are different strengths too, depending on how long the market stayed there and such too. But as you start to break through those support points, that's basically just the definition of not having enough people interested at that price. And so dip buyers are going to continue to buy until one of two things happen. They buy everything they can, which can happen. I think that sort of happened in 2000. And there's not enough money on the sidelines to really keep it going. And eventually it comes back down. Or they just stop believing that it can go up, right? For different reasons.
Yeah, so it could be like just a confidence vote of confidence. If you shake the investor sentiment enough, people will leave, become fearful.
I mean, a perfect example in this particular scenario is that AI turns out that it's not working nearly as well as people thought it might, or it's so far off. Whatever it is, something changes the AI story and slows down that build out. It's the only thing driving this economy and the stock market is that. So if I'm a dip buyer and all of a sudden I can become convinced that the AI trade isn't going to work, at least as it's significantly set up now, or it's like so far ahead of itself that it's ridiculous, which is what happened in 2000, then you'll start to see that dip buyer back off theoretically because of that. So I look at the charts, and so when I see the market kind of coming back down like it's doing now, we're not getting even close to any major support points that I see, and we're still seeing some dip buying as it is. You can see it in individual stocks. If you look at the quantum computing stocks, for example, I was looking at Ionic today. It's down a bunch from its high, but it's right now right at the first support point. And so, it just ran like 80% in a month, and it gives back 50 or what have you. That's not that unusual for something like that. But it's at that support point. So does it then fall through that? So that means, and then maybe the next one after that, it starts to mean that the dip buyers are no longer interested in that company. Yeah. And so anyway, that's, in essence, that's what it is. It's a giant number of stocks that everybody has a belief in or not. Some end up falling, but if enough keep going because the dip buyers believe in them, that drives the whole market, especially if they're the bigger stocks, which is really the big drivers on these indexes. But it's a good question. It's really interesting. And that's why I still feel, if you look at it closely, that this market still has some room to run, because the dip buyers seem to be pretty active. They come in pretty soon. We haven't even had a 5% drop. Hasn't been allowed yet. I'm sure we'll get one, because even with good dip buying, we still ended up with a 10% drop in the summer of 23 before things really took off again.
Yeah, and occasionally you'll see profit taking. This week there was some profit taking in the retail and tech companies where people were selling off earlier in the week. And
SoftBank sold $5.8 billion worth of NVIDIA, just flat out, just sold it. It's a pretty interesting move.
I think for them, they felt like could get better returns with.
I don't know. I read a whole article on that. I thought it was really fascinating, just in the sense that selling all of it is pretty unusual. So it kind of made a little bit of a statement, along with the Michael Burry shorting, information that came out. And, they're not going to be wrong either. The problem is NVIDIA could go up 100+% before it falls. And that's where the problem lies in either selling it like SoftBank did, and they want to redeploy it. A lot of times that sounds like, like these politicians that get in trouble that resign because they want to go home and spend time with their family. That was kind of what that reminded me of today this week with NVIDIA. So yeah, anyway, it's I think the dip buyers are still there, but there have been some sells, and there are some people like Michael Burry that are looking at it as a topping action here.
So has NVIDIA become too big for future returns that, even though the future returns could be good, but it will be moderated just because of the size, It can only go so fast once it gets to 5 trillion, to make it to the next trillion. You know, when is it time to exit or take some profits when you have a home run kind of investment that's starting to be a concentration in your portfolio?
Well, from a big picture standpoint, you do so when what I call the story changes, right? Mm-hmm. So if you look at GE and you watch what happened to GE, one of the greatest companies on earth, original Dow component from 1880 something, and they dropped 90%. And what was happening was, if you watch, unit by unit, they were just falling apart, the leadership. Intel, another great example, and this happens to all companies, but the brains leave because the stock has made so much money, everybody retires, and you don't always get everybody back in that's at the same level. And so that's the big time to sell, However, it doesn't preclude you from taking a look at lightening up your stake even when those situation hasn't happened. So NVIDIA's story has not changed. I mean, I actually have a chart we used. This came from Bloomberg. They were talking about how all of these companies, OpenAI, Microsoft, NVIDIA, AMD, Oracle, and so they're kind of shifting the same money around in circles. But my main point here is look at what's in the middle, NVIDIA. And so the problem for NVIDIA, and one of the ways that the story can change, right? And like Peter Lynch, who managed probably the best track record in a publicly traded fund, was the Fidelity Magellan Fund, and he had several books, but he didn't like technology because things can change behind closed doors that you can't see. So, for example, he used to love La Quinta, which was a hotel chain, right? And he did really well with it. But he liked it because you can see the competition coming. Somebody can't open up 1,000 hotels overnight, but somebody can create a better chip than what NVIDIA's getting and surprise the world with that chip, and NVIDIA's going to have to play catch up. It's not likely, but it's possible. So that's the type of thing where the story can change so fast you could end up with a loss before.
The moats in technology are a lot harder to maintain.
Yeah, they are. They are. China could come out with something, surprise everybody or whoever. So, but that, getting back to the question, there's a couple strategies, right? The one strategy that I try to use quite often and recommend to the clients is what we call the fruit tree concept. And so you pick a dollar amount, that you're comfortable with, that you want to own in NVIDIA. Whatever that 2 million, whatever it is that you have, it's it's different for everybody. And then what you do is you say, okay, at the end of some time period, quarterly, semi-annually, or annually, you kind of take a look at it and you say, okay, I want $2 million. It's now worth $2.5 million. I'm going to sell $500,000 worth. I'm going to pay the tax and diversify the rest. But I still have the $2 million. And so it's a fruit tree concept because theoretically, if it continues to grow, you always have the 2 million. That's your fruit tree, and you're picking the fruit off with these components that are higher than that. If it drops below 2 million, then you're kind of a buy and hold, and you're just going to wait and see how it goes. If the story changes, then you might deal with that 2 million and reduce that exposure even farther, right? Does that make sense?
Yeah, another one that I've heard is where someone will sell out, how much they put in. So, if you put in $10,000, now it's worth $50,000. Right. Maybe you take $10,000 of the stock, you sell out, get off the table, and then you feel like you're playing with house money in a sense. Money that is kind of profit on the existing what you've made.
Yeah, both of which allow you to reduce the exposure in some logical manner. that hopefully would make you feel better about owning the stock, if
Yeah,
that makes sense.
the goal is to be comfortable with
Right.
what you have. If you're starting to feel worried or stressed about how much you have of one stock,
Yeah.
that's when you start to think about, how do I diversify out?
Yeah. Yeah, and my experience is that it's very difficult for people to do what we're talking about, mainly because a lot of times it requires some capital gain that you have to deal with, and people would rather watch that thing turn into a loss sometimes, it seems, than pay the taxes when it was at a high. I would bet anything, if you looked at the overall scope of what happens, people on average lose a lot of money because of the tax consequences they're worried about paying. Taxes are big. It's a big piece of the thought process for retirees, especially because it's one of their top 3 to 5 expenses in total. So, increasing that is just sort of this pain point for them.
Especially when especially in retirement, when you have Irma cliffs, and if you go
Yes.
a dollar over the cliff, you're paying for the 2 years later, you're paying just a premium adjustment, which is
On your Medicare, yeah, exactly. Yeah, so it becomes a pain point situation, right? So you got a client who says, "Oh, I'm worried about Nvidia. It could drop. What should I do?" And so they've got a pain for that. But then when you talk about them having to pay the taxes, that pain's higher. Almost always, and they don't want to do it. Now sometimes it's in an IRA or whatever. It's not it's not as critical, but it is an analyzing the pain of the different decisions and the different paths that you could go down. And as humans, we generally go towards the pain with the least amount of the path with the least amount of pain, right? And so taxes are pretty painful for people. It's hard for people to fork over that much money on something. And the worst case scenario is it continues to go up and up and up and up, and you realize, I should have just kept it. I won't have to pay the tax like I'm paying now. But you're doing it because of the other scenario, which is things pull back. I mean, Cisco went from a nice little company to the world's largest capitalized company for a short period of time in the dot-com run-up. And so people look at NVIDIA and see some similarities to that. They came from, back in the pack to the top. It's different. Cisco didn't have an innovation strategy per se. They did some innovation. Matter of fact, up front, invented the router for all intents and purposes. But those were the founders, and they left very early. And so most of Cisco's growth came after that in acquisitions and mergers. And so when that started to fall apart, they didn't have anything. NVIDIA is more like Intel. Could go for a lot longer. Intel went for a really long time. They were a really good stock for a long time because nobody could keep up with the speed of their chips until they did. That's when the story changed. When Apple started making and AMD started making chips that were, for the money at least, if not actually faster, but at least for the money, were
the better value.
Better value, yeah. So that hasn't happened to NVIDIA yet, but that's it's a great question. It's a good company. It's really interesting to talk about. It's a real major success story, and don't be surprised if it's not a $10 trillion company. I don't see a massive probability of that happening, but I wouldn't discount it. I mean, it's just the way it is. All right, we have time for one more, maybe.
Yeah. What do I do with or actually, let's do this question. When can I start my QCDs? What time of the year should I complete my QCDs? And QCDs are qualified charitable distributions.
Okay, so once you're 70 and a half, if you are if you have a retirement plan like an IRA,
it's only for IRAs.
Yeah, and so you can gift your charity money right out of your IRA and not pay taxes on it.
Yeah, it's excluded from your income, so
Right.
it basically never shows up on your tax return. It just goes out to the charity directly.
Yeah, and so it's a little bit weird because between 70 and a half and 73, you do not have to any longer take a required minimum distribution, but you still can do a charitable distribution. So, but when to do the charitable distributions and to understand what they are, let's say somebody's already giving $10,000 away for charity, you can start to give that money straight out of your IRA, and then nobody pays taxes on that, which we normally would pay taxes on.
So it depends on what your needs are. Are you trying to manage your future tax burden by lowering your RMDs? Then it may be a good idea to do QCDs ahead of your RMD age. Otherwise, if you donate from your checking account, you get a tax write-off.
Yeah.
That you could use.
Yeah, and then there's the question's kind of twofold. Doesn't specifically say like what age. It just says when. So we're covering what age. So 70 and a half and beyond, you can do it. There's some advantages to it, but then also just what time of the year to take them out. And so for us, the earlier the better as far as we're concerned, because in the end you still have to take, especially if you have a required minimum distributions and you're 73 or older, you still have to take that out. So if you need to take out 89,000 by the end of the year, we need to know how much has gone to charity so we can net out. So if you gave away 9,000, we can get out the other 80,000 out there. And
if you're writing, our custodian Schwab allows you to have a checkbook for your IRA to write checks directly. If you're writing checks directly to a charity, it will need to be cashed by the end of the year to count for your RMD or any kind of for that year. And ideally, by the end of November at least, because you still have to have time to calculate the RMD, get it out, and these companies get kind of run over at the end of the year. Sometimes they even have deadlines for when you can put in those requirements. And so, very popular within our clientele is to get a checkbook, mainly because they don't know who they're going to give to for sure for everything, and something comes up, they just get out their checkbook and send off $100, And so it's part of their charitable giving. It gives them some flexibility. Of course, the disadvantage to that, again, is you're writing that check. In order for it to count against your required minimum distribution, it does have to cash. The other way that you can do it through Schwab, for example, is you can fill out a form and say, here's my charities, here's the information you need to know to send the money, here's how much to send. And then they send that, and once they send it, it gets counted. You don't have to worry about the charity getting it, cashing it, or any of those things. So both of which are useful. So, we'll often use the Schwab form version when we get to the end and it's getting too late to do these contributions by a check. So anyway, 70 and a half based on age is when you can start them. And then of course, earlier in the year with the charitable contributions is easier to deal with, in my opinion. And QCDs are a way to control your taxable income. So like, let's say you're getting close to Irma Cliff. You want to be not close to it. Maybe you do $5,000 of donations to charity. You're now below that cliff. You save on your premiums and your
and so in Medicare, what happens, once you get to be 65, is that there's a means test, right? There's a table and said, okay, so if you make over 167,000, you're going to pay this next level cost. It goes up a lot. I mean, I think from the lowest to the highest, it's roughly 4 or 5 times higher.
Yeah, and the idea is that Medicare is supposed to be subsidized, and so it's mean tested to reduce the subsidy.
Yeah, exactly. So if you have a lot of income coming in, but the unique thing about it, so for example, if you look at federal tax brackets and you're in the 24% bracket and the next bracket's 32%, if you go over the 24% bracket by $1, you're only going to pay 32% on that $1, right? When you look at what happens within the Medicare brackets, if you're over by $1, you're going to be in the next bracket, which could be $185 more a month, or whatever it might be. And so that's where you can kind of manage that. Say, oh, it's 167. I'm at 175. I'm going to give away enough money through QCD to get myself back down under 167. And save that money on Medicare. So anyway, that's part of the tax planning. You're looking at tax brackets, state and federal, and you're looking at Medicare if you're getting it, if you're 65 and over, and what the limits are there. And now the other one now is this $6,000 credit that you can get too. And so looking at all of those and trying to figure out where you stand and trying to manage your income if possible, not always, but if possible, to try to get under some of those different levels to make it so you have more left over at the end. So it's a good question. It's a very powerful tool. It's really popular within the clientele, the QCDs. So all right, good. That's our show for today. We're right on time. Look forward to being able to see you again next week. If you want to send in questions all during the week, and we can look at them and maybe do some research on them. And of course, if you want to, subscribe to the channel, go to here and hit the subscribe button, the bell button will notify you when we put out new content. And if you'd like to meet with Ethan and I, on an appointment basis, our appointment button is at the top of our webpage. Link for the webpage is on this channel here. So set up a 30-minute time with Lisa and I to chat with you. So anyway, look forward to being able to see you next week, and we'll talk to you then. Thank you very much.